Good morning, everyone, and welcome to another edition of Markets with Santo and CJ. You are tuned in to the Money Control live stream. Santo, yesterday we had a mega earnings coming out. L&T bro, what did you make of it? It's one stock that you have been, vying for a long time.
Definitely, CJ. It depends on how you look at the numbers, but broadly, I would say that the numbers have been much better than what market was expecting, both in terms of order flow as well as revenue.
Right.
There's been a lot of skepticism over whether the Capex cycle is still strong or is it showing signs
whether it has even started or not.
Well, at least the numbers
question.
here, if you look at the order flow of L&T during the June quarter, about 57% year on year, I think that should put to rest concerns that the market may be having as far as the Capex cycle goes. There's definitely some bit of improvement there, still a far cry from what it ideally should be, but there's definitely an improvement out there. Most importantly, CJ, the company has again maintained its revenue and order book guidance for the rest of the year. So that I think is a major positive. I would be very bullish on this stock.
Well, Santo, I think for me, you talk about the order inflow, of course, 57% year-on-year jump, but the other aspect of that is a lot of it has been driven by international orders as well. Clearly, the surge in crude oil prices is clearly benefiting the Middle Eastern economies, and from there, given L&T's large presence there, we are seeing a lot of business coming in from there for L&T. But for me, I think if you look at the sequential business momentum, that has slowed down a little bit. I mean, if you look at the EBITDA, that has clearly seen a sharp fall on a Q1Q basis, largely because of higher construction costs that we are seeing from the company. Also, for me, the higher share of international orders, which is now almost 43% of the overall order book, poses a risk. If we see crude oil prices sliding going into the future, then probably the Middle Eastern orders might slow down going ahead. So that would be something to watch out for. And lastly, I mean, the infrastructure segment, I think there was a little bit of a concern in the fact that margins on a year-on-year basis were a little softer, which basically is showing you that the cost concerns that are there for the company are clearly taking a toll. And this is something that may not, go away, although steel prices have come off 50 to 20%, but they still remain elevated on a year-on-year basis from the previous September quarter. So something that you might want to watch out for in the September quarter is how the margins fares for the infrastructure segment, which is the biggest segment for L&T standalone. Apart from that, I was thinking the stock is about 15%, I think, from its 52-week high. And overall, in the past 2 years, you have seen almost 80 to 90% gains in the stock since July of 2020. But is there enough upside left? And I was just, looking at how the institutional investors are doing. And apparently, institutional investors have been trimming their stake in the company for the past 2 quarters, especially foreign portfolio investors, which goes to show that maybe the upside from here on, despite the numbers that the company has posted for Q1, might be limited.
Well, if you go through the post-earnings research notes by most brokerage houses, they're also betting on good execution, which is, there seems to have faith in the company's ability to execute. I take that risk about, oil prices probably cooling off a little bit, and then that in turn affecting orders from the Middle East. But I think the possibility of that is a little slim at this point in time, given how crude prices have been behaving. At least for this year, there's no risk to the order flow as far as one can see it. The second point about the upside, again, most broking houses have a target of plus 2,000 rupees, which is still a good 20% up from here. So even if you're looking at a 1-year return of 20%, higher than 20%, I think it's a decent enough return in this market.
Well, brokerage targets are one thing and achieving those targets are another thing, Santo, right?
Oh, well,
that
CJ.
said, let's quickly take a short check on how the market is setting up for today. Clearly, we are in for another muted start this morning. It doesn't seem like much is happening in the market if you look at globally as well, because of that crucial event later in the evening today. But if you look at the cues from Wall Street, they ended lower on the back of some weak tech earnings. You had Google, Microsoft numbers coming in below expectations, so that really did sour sentiment a little bit. And on top of that, we have the ongoing concerns around recession in the US. So not really great cues. Also on top of that, we had the International Monetary Fund actually coming out and slashing growth targets across the board. I mean, for global GDP, Chinese GDP, US GDP, and even Indian GDP, forecast for 2022 have been slashed by the International Monetary Fund, and it has warned that recession risks seem very imminent for 2023. So clearly, Santo, the macro environment not really providing any comfort to investors.
And again, we're seeing a pickup in FI selling as well. Yesterday they sold close to about 1,500 or 1,400 crore worth of shares. So that's not turning out to be a worry. Last week there was what looked like a slight reversal in trend, and that turned out to be very short.
I mean, even in the F&O space, I think if I'm not wrong, they have actually brought down their long positions on the index. So that is also not going to.
Yes, the market depth, which I've been mentioning earlier, also that now seems to be a worry. So this makes the market vulnerable to very sharp moves in the short term, depending on news flow. So that is something one will need to watch out for.
Yeah, I mean, Santo, if you look at the average daily turnover on the NSE, clearly on a month-on-month basis, we have been seeing consistent decline since April. So clearly, not a lot of investors are at this point of time interested, given also the fact that the market has also not done much. If you look at the past 9 months, this is a market that has been very, very stagnant, if you can call it that. Even though on an intraday basis we might have seen volatility, but it's a very stagnant and a very boring market if you look at it from a long-term point of view. That said, Santo, let's move on to the other stocks that are on your radar.
Well, starting with Shoppers Stop, CJ, this was a stock I was skeptical on till a couple of months back, but I think the market is proving me wrong on that count. And
I told you.
And you have seen a decent set of earnings for the June quarter as well. Now, one could argue that, compared to the pre-pandemic levels, we are still to come to that level of turnover. But I think the market seems to be betting that the company will be able to make it sooner than later. And the most heartening thing about the first quarter earnings was also that it's managed to improve its operating margin, 17% operating margin, which is the second highest in almost 11 quarters. There's a significant margin improvement there. This apart, I think, just look at the price performance. The stock has risen more than 60% this calendar alone, which means that valuations are expensive, no doubt about that. But I think when it comes to valuing retail chain, I don't think the normal P formula works. The market seems to be looking at something else altogether. The stock has always been expensive. So that's the base of my argument.
Well, Santo, you turning bullish on this stock maybe is my indicator to turn a little cautious. Yes, true. I mean, the earnings have been quite good if you look at it on a year-on-year basis. Even on a sequential basis also, the business momentum has continued from the, has picked up from the March quarter. But the one thing that really nagged me is the fact that, I was going through their investor presentation and they have said that business footfalls or average footfalls at their stores has neared pre-pandemic levels. It has not gone above or matched it. It's still nearing, right? That means that even after what has been almost 4 or 5 months of no COVID-related disruptions in the industry, Shoppers Stop's footfalls have not recovered. You take Reliance Retail on the other hand, they have seen almost 20% jump on footfalls from pre-pandemic levels. So clearly, I think there's something not clearly working out in favor of Shoppers Stop on that front. Also, for me, earlier in the quarter, I was bullish on this stock because we believe that there would be pent-up demand in Q1 because of schools opening, offices reopening, and there will be a lot of demand. I think that pent-up demand might peter out now going ahead into the coming quarters, and it will be interesting to see whether actual demand sustains or not, on a sequential basis. And the biggest risk, of course, for apparel makers, not only Shoppers Stops, but apparel maker across the country, remains the high inflation. I mean, with inflation being so high, whether consumer spends will sustain at the levels that they have been for the past 3 or 4 months, that'll be important to catch. One stock, Santo, another from the consumer space that I was really interested in is Relaxo Footwears. A very strong set of numbers for Q1. If you look at the underlying demand trend, it seems like the company has managed to sustain the momentum from the March quarter, and clearly it has benefited from the reopening of schools and colleges, with kids now buying new set of footwear. Of course, they have all grown older since the beginning of the pandemic, so clearly there was a need for a new pair of shoes, and that pent up demand has clearly helped the company. And I believe that probably going forward also we will see that sustaining, in the sense that offices are still reopening and not all of the offices have reopened, so clearly there could be something there. And Relaxo also, by the way, is focusing on the athleisure segment a lot, just like Campus Activewear, so clearly there could be some bit of margin benefits also coming in for the company. But talking of margin in Q1, clearly there has been pressure. I mean, high leather prices have taken a toll on the company's margin. But I would expect that with crude oil prices softening in the June quarter, maybe we could see some of that pressure come off in the coming quarters.
Well, expensive stock, but that again is not my issue here. Expensive is fine as long as the numbers kind of grow to
justify them. Yeah,
justify them. In the case of Relaxo, I don't think that is really happening. The top line has been, within a certain range for a long time. Now, the interesting thing about Relaxo is that I was just going through its annual numbers, and for FY21, when it was a year hit by pandemic, you didn't see any major impact on its top line. In fact, it was almost the same as the previous year. So resilience there very clearly, strong business model, demand is steady, but that's about it. The sales really are not breaking past the range. So that being the case, I would wonder, why would the market want to pay the expensive valuation that it's paying. Secondly, the stock is now almost 20-25% of its top and been among the laggards this year. Again, probably indicating to me that market somewhere is waiting for a better trigger, so that it can actually re-rate the stock. So it may not see any big upsides from these levels.
Well, Santo, I think as far as Relaxo is concerned, it seems like a more of a tortoise bet than a hare bet, right? This is a company steadily is growing, its top line as well as bottom line, not for just the past 1 or 2 years, but for the past 4 or 5 years now. So I think the bet here is more of a longer term bet on Relaxo, that it will be able to gain market share. It will be able to, if it makes inroads into that athleisure segment, or the athletic segment or the high margin segment, then probably what investors are betting is the margin profile might change quite dramatically just from the levels that it is right now. And maybe that is what a lot of institutional investors probably seem to be betting on the stock at this point of time.
Well, Aditya Birla, the next stock on our watch list, fairly disappointing set of numbers. But CJ, when I look at the stock, it seems to have bottomed out around 400 rupee level. It made a double bottom there, despite the steady flow of negative news. The fact that it's a strange dichotomy here, CJ. People are bullish on the equity market. They're buying, they're investing in mutual fund month after month. But here you have, the
companies themselves or stocks themselves
all
not doing
them
well.
Have been consistent underperformers. Now, according to Yes Bank, Aditya Birla AMC's market share, it's been losing market share in the equity segment, but the pace of decline has somewhat moderated in the second half of last year, and that probably is now, we could be probably on the cusp of a turnaround here. And the fact that the stock has been showing kind of resilience probably shows that we are looking for better days ahead.
Look at you, looking for silver linings even on a bad quarter like this. I mean, Santo, I don't know. I have really nothing that came out from those numbers that really impressed me. It was a very unimpressive set of Q1 numbers, and which basically is showing the reason why the stock has been so dormant over the past, since the time it has actually listed. And I think overall the industry dynamics itself is not really that great. Santo, you talk about the fact that a lot of money is coming in via SIPs into the equity space, even in the debt space, but the fact is that AMC as an industry is facing a lot of competition, right? Margins are under pressure, competition is high, new players are getting into the space, and generally investors are very wary of industries where there is competition is at a very high level, because of course your profitability and your market share will always be vulnerable to be priced away from somebody else. And if you look at it even from a technical point of view, Santo, the stock has been very, very neutral in terms of technical indicators, which basically is showing that there is there is very less bullish momentum on the counter. And I just feel that probably investors will continue to ignore the stock in the medium term, at least till the time there is tangible evidence that we are seeing some market share gain. We are seeing some market share gain in the SIP segment as well. That would be more important, because SIP would benefit your earnings more than just say lump sum inflows into the market. Well, last stock, Santo, on my counter is Tata Power. Well, if you look at the year-on-year earnings, pretty good, healthy demand trends in Q1, but of course margins were under pressure, and that was quite obvious given the high cost of coal. I just hope that tariff revisions that might come in for the company might be able to boost earnings going ahead. And lastly, for me, I think that, Santo, the key driver for the stock will be the renewable energy portfolio. I think that will continue to drive valuations as well as earnings going ahead.
Well, before I counter that, a quick take at the market, down 18 points in early trade. Breadth is pretty steady at this point, close to 900 stocks up and 700 and stocks down. Nifty Bank is flattish, slightly down.
It's a very, very flat market. Clearly, if you look at the mid-cap space also, 0.1% higher than Nifty mid-cap. So even the Sensex just barely turned into the green. So very, very flat market. Santo, it seems like investors and traders are not willing to take any sort of position ahead of the crucial FOMC meetings outcome later in the evening. And I think we will only see something happening later in the day tomorrow. I think the only crucial point in today's session, Santo, for me would be the fact that tomorrow is expiry, right? And it's monthly expiry. And generally you see a day before expiry, around 2 o'clock, 2:30, you see a lot of square off happening in the market. Now, whether this square off will be on the unwinding side of long positions or whether there could be some sort of covering of short positions in the market, we will have to wait and see. But I think around 2 o'clock, 2:30 will be very important to see how the market movement is.
Well, coming back to Tata Power, going through analyst notes, the impression one gets is that it's basically the coal business that has come to the rescue of Tata Power, but it's not into the business of coal really.
Exactly.
CJ, is it? And then there are issues with its coastal Gujarat project as well. While the Supreme Court has ruled that it can exercise Section 11, which allows it a pass-through mechanism, it will still need to sign supplementary power purchase agreements with its customers and have that to be able to pass on that price. So it's not a done deal yet, and till that happens, according to HDFC Securities, this is going to be a short-term solution, and that the problems at its Mundra power plant will still continue. And lastly, CLSA has a sell rating on the stock. It is pointed out that the stock is still expensive even after the recent correction.
Surprising. I mean, the stock has fallen almost 11% this year, more than 11% if I'm not wrong. So clearly a little surprised that CLSA still believes that the stock is expensive. I feel that probably valuations, of course, are nowhere close to the frothy levels that they were back in October, November last year, and there has been a meaningful correction since then. So if people are looking at maybe getting into a renewable energy segment, into that space at reasonable valuation, maybe Tata Power is something to worth looking for. Santo, one question it's come in from one of our viewers is the fact that, of course, we have seen with what has happened with Zomato, right? I mean, the stock is now almost at 40 levels, and the question is basically, do you think all startups got listed last year will see the same sort of pressure when their 1 year window will end, like Zomato? Like, so for example, the lock-in period for a lot of the pre-IPO investors ended earlier this week after a year-long lock-in period, and something similar might happen with, say, Paytms of the world and PB fintechs of the world. So do you believe that some same sort of pressure could be seen there?
Well, theoretically yes, but a lot would again depend on the business model, the outlook on the business model for each of these companies. So if investors feel that there is a chance that probably in a year or two, see, the whole problem in many cases is about valuations, not so much about the business model, right? But if investors were to take a slightly, if they have reason to believe that the business will do, let's say 4 quarters or 6 quarters from now, maybe they will hold back. So it's more to do with their outlook on the company as a whole.
Well, I think, Santo, my view on this is the fact that, see, you cannot buy or sell a stock depending on what somebody else is doing, right? Everybody will have their different point of view on a stock, and that is why we love the stock market, because there is just no one opinion that drives the stock, right? Even if you're say a pre-IPO investor in a Nykaa or a Paytm, and you have bought the stocks, say maybe at 2 rupees, 3 rupees or 10 rupees, you're still making a lot of money, right? So they are well within their rights to book their profits, because ultimately it's not like they're totally exiting the counter. If they're totally exiting, then you have a cause of concern as to why a smart investor like that would be totally exiting a counter. But if they're booking some profits, I think they are well within their rights. But that should not affect your point of view on the stock, because your point of view is totally different from what their point of view would be. So that would be my answer to that question.
Well, with that, it's a wrap on this edition of Market with Santo and CJ. Thanks for watching, and do share your feedback in the comment section below.
And as usual, guys, keep following us on the social media links that you can see at the bottom of your screen. And for rest of your financial news, stay tuned to moneycontrol.com and download the Money Control app. We'll catch you again live at 3 p.m. with all the day's action and stocks. Till then, have a great trading session.